Let's get to our jobs preview panel. We've already been talking to these guys. Joining us now, Jonathan Golub, Chief U.S. Equity Strategist at UBS Investment Research. Mark Zandi is Moody's Analytics Chief Economist. He brought us the ADP numbers on Wednesday, which started the ball rolling on swoon talk, and then the claims number yesterday didn't help either. And then Mike Darda is Chief Economist and Chief Market Strategist at MKM Partners. Jared's here. Jared Bernstein is a former economic advisor to Vice President Biden and a senior fellow at the Center on Budget and Policy Priorities. And don't adjust your set. That is another person. It's not just we're not just duplicating that. That's Austin Goolsbee, professor at the University of Chicago Booth School of Business. Wow, that's quite a lineup. All right, where do you want to start? All right, you supposedly know how to invest in the stock market, right? Because you need to do that at UBS.
Right.
Is this how much of what happens today would dictate whether you stay long or not?
This number, probably not. I mean, this is a volatile series. You had a bad January, you had a good February. The question is, where is this in terms of the trend? We're expecting about 200,000 jobs as a trend throughout the course of this year.
Okay.
If this is part of a pattern of weakness where we see that that's eroded, then I think you want to bail on the stock market a bit. But it's one data point, an important one, but just one point.
We haven't spoken to you, Austin, in a while, so I'm going to jump to you because you're in a bad mood again. You said you said 153, and then you got worried about some Price is Right stuff, and you went to 149 because you didn't want. I think you want to be below 150 so that you can throw it in Zandi's face if you're right again, right?
Yep.
Why?
You got to decide which of us is Clark Kent and which one's Superman. Look, I'm getting pessimistic again because I thought the economy was only slightly turning upward. I think people overreacted last month with the good news, and now I think the sequester is just going to have a debilitating half a point off the growth rate effect that's starting to kick in, and that's going to mean the jobs are going to be back down to 150 and below.
Yeah, I think that's right. Yeah.
Below 150.
Yeah.
But are you 175 or 150?
If you took a straight up calculation of ADP, it would say 149. Yeah. So I think Austin.
Oh my gosh, you're in the same place.
Yeah. I use a bunch of different models.
Your stuff.
That's okay. That's okay.
He's trying to cover. You can see he's trying to cover his bases.
I am. I have a bunch of models, and I think it is going to be closer to 175. But the straight up ADP would say 150. So.
Mike, where are you?
I'm at 175 also, 185 for the private sector.
Did you come down this week?
Yeah, I think with the ISM services employment index is a bit soft. ADP was a bit soft. Claims, I think, a little fluky here. And in the survey week, they actually made a cycle low. So that one I don't think is as bad as what was reflected yesterday. But the 12-month moving average is right around that level, 165, 175K. I think for the year, we're probably going to be around 200, maybe a little bit above that. So I'm fairly optimistic for the year.
You worried about the sequester?
I'm worried about it less with the Fed doing a supportive policy, housing reviving. So, the sequester's there, but the Fed actually did QE3 and implemented the Bernanke-Evans rule in part because of these headwinds that were out there. If we look at overall financial conditions, they're consistent with somewhat faster growth this year. I think we're going to be closer to 3 for the year versus 2 for the last 3 years. So we'll see how it ends up. But
I don't think Austin would agree with you. He's a sequester guy. You said something about Obamacare. Austin, do you see any headwinds from Obamacare, the 50-employee rule?
In a weird way, not in the job market. There are two sides fighting over what's going to happen from ACA. One side says it's not going to do that much, that when they had the surprise announcement that the mandate was legal, the stock market didn't go down, so maybe the aggregate impact won't be that big. On the other side, if you think everybody's going to start moving guys from full-time to part-time to get them under the hours cap, in a weird way that would actually make the unemployment rate go down, make the average work week go down also, but it would have more people being employed because you'd have 2 people 20 hours a week instead of 1 person 40 hours a week. No improvement to the job market, but in the data that would actually not look like a headwind.
Yeah, there are a lot of cross currents, but those companies that are near that 50-employee threshold are going to work really hard to stay under that threshold this year because they're going to take 6 consecutive months in this year, and that determines
their 2013.
Yeah. That it determines what they are going to pay on health care reform in 2014. And I'm not making any comment on the merits of health care reform. I actually think there's a lot of good in it, but I do think there is an adjustment, and we're going to see that adjustment this year, and it's going to be now and through the middle part of the year, and I do think we see some impacts on employment.
Jonathan, we've pointed out that the last 12 sessions have alternated up and down, and some people are I saw the thing on the bottom of the screen said last hurrah for the rally, things like that. Is it tired or is it consolidating?
If you look at the trend of economic data and then you look at the market move, the market's gotten way ahead of the fundamentals. So I think whether it was going to be
do that, Jonathan.
It's supposed to do it to the extent that the fundamentals are going to support it. I mean, this quarter we're going to go into earnings season. You have consensus is for 0.5% growth in earnings over a year ago. It's really hard to see how that's consistent with a 15% run in the stock market since November. So I think that this is likely to pull back a little bit.
Well, where are you on the S&P for earnings this year?
We're at 108, which is roughly
15 times earnings.
With
zero interest rates.
But you have, but last year you had 104, so you're talking about a little bit less than a 4% earnings growth.
But certainly not expensive.
Not expensive compared to what? So, I mean, if you look at the
historical price to earnings multiples with zero interest rates.
Well, we've never had a zero interest rate environment to compare it to. Let's enjoy what we have. But if the question is, what are you willing to pay for really, sub 4% earnings growth? And that's a real challenge.
We just had Mark Mobius, who's so smart about making money, and he said, you got 0.4% for 10 years in Japan, you got 1.8% for 10 years here. Why would you not be in 3% yielders in the stock market?
I'm not sure that you don't want to be in the stock market. The question is really what kind of returns you're going to get. I think that you should get earnings growth, and earnings growth are going to be in this kind of a 2 to 3% or low 2s economic environment. You're talking about 4% earnings growth. So as long as you have meager expectations, I think the stock market's going to be fine. I just think that this belief you're going to get 8 to 10 in a low growth, low yield environment, I think is just going to be a bit difficult.
All right. Austin, I'm not talking about the female demo when Darda is on, but are we swooning? Are we swooning as far as the economy in the spring again?
What do you mean by swooning? Meaning
we did it
not
twice.
Doing well?
Yeah, we did it.
This is not like
twice.
Falling in love swooning.
Yeah,
this is like
I mean in a bad
swooning.
way. We did it twice already in the last couple. Remember, the spring swoon, and people are worried about swooning again.
Yeah, I think they should be. Now, I don't think we're a long way from the days when everybody said, are we going back into recession? But I think you've got partly this seasonal adjustment issue and partly just the reality that I think people got way ahead of themselves last month. What we've had on trend is modest growth, and now we're going to pull back from modest growth with the sequester coming in. So I think we're looking at a bit of a swoon.
Jared, I'm sorry, buddy. Oh, my God. Right. I know what you think. I know what you think, but that's not why I haven't been talking to you. In fact, Eric Cantor loves your old boss. Did you hear that?
Yeah, I saw that.
Are we going to, is it the sequester, and are we swooning? Jared?
Well, first of all, I've been enjoying the conversation, so thanks for bringing me into it. First of all, I thought the conversation you just had about the markets was interesting and on target. The opportunity costs of being out of equities are just very high right now, and I think that's kind of a bottom line. Look, I mean, you just heard someone say that they think GDP might be 3% for 2013. That's an acceleration. I'm probably closer to 2.5%, but that's on trend. So I don't see swoon. I see continued trend growth, and I think that's not good enough. The reason why we're stuck at 7.7% unemployment, way too close to 8%, and have been there for a while, is because GDP has really been trucking along a trend, or worse, if you kind of smooth out some of the bumps and the spikes. And so I just see steady as she goes, and she's not going fast enough.
Yeah. And I don't know what the answer is necessarily. I'm more confused than ever.
Oh, I have an answer.
I know you. I know what your answer is going to be.
You need to help the Fed.
You want to borrow more. You want to borrow more money from China to put it into questionable investments, thinking that the government actually knows what to do with the money that it borrows from China.
Well, let's be clear. Well, first of all, let's be clear. I think that at this point, China holds about 10% of our debt, so it's not just
anything
China
we do, though. It adds to our deficit, though, and you know we got to finance
that's right.
it. So
no,
it better
right.
be a good. Hopefully, it's not going to be renewable energy that can't compete with natural gas.
Let me let me say one fiscal point that I think you guys overlook too much. Anything that's truly temporary, something that lasts 6 months, a year, even the Recovery Act at this point is adding almost zero to the budget deficit, and that was $800 billion. It's stuff that gets in and out of the system that helps you on the economy and doesn't hurt you on the deficit. So that's what we need to help the Fed, to complement the low interest rate policy. I suspect Mark Zandi would agree with me.
Yeah, no,
he designed the stimulus.
But the reality is that there is going to be no fiscal policy, additional fiscal policy.
Right.
This is now.
That is the reality.
This is written in stone, and we're going to have to ride this through.